Welcome to the daily update, where I'll go over the action in the market for Monday, March 10th, and we'll see how things look for Tuesday, March 11th. Really down day. Pretty severe decline. Things are looking negative. We're extreme negative as far as sentiment, but we've been there for a while. And we're dropping below daily support and even weekly support. There's still some support that we could bounce off of, and I'll show you that a little bit later on. It's long-term support, but we're negative in the short and intermediate term. We're negative in the long term in the sense that we're below the 200-day moving average, but we're positive because the 50 period moving average is still above the 200 period moving average. Okay, so right at the open, we had a gap lower open. There was very little attempt to buy the dip. A lot of folks that have been trying to do that recently got burned, and I guess three times bitten, one time shy, kind of a thing. Um, so that just didn't work. We saw a little bit of an upward move at the end that I'll show you, but that might have been just bouncing off of long-term support with a little bit of short positions being closed. But we had a gap lower open at S1 at 56.97. So we're actually under the 5,700 level now. And we're dealing with the 5,600 level. And we declined down below S2 at 56.23. And it's just a pretty much straight down shot there. We declined down to about the 55.65 level. So now we're falling under 5,600. This is getting close to a 10% decline from the all-time high that was set back in February. And I have a chart to show you that. And we'll have to see if things play out, because if we lose this support, things are going to turn much more negative than they already are. Then we bounced up a little bit and closed slightly below S2. We were down 2.7% on above average volume. As I said, we're negative in the short and intermediate term, but we're oversold both in the short and intermediate term. Long term is vulnerable right now, but there are some areas that are still holding. And a lot of this has to do with the tariffs and comments that were made over the weekend by President Trump. And it's like, well, we voted for you for all these changes, but did we really mean that? Now that you're trying to do these changes, we don't like that because it's affecting me personally, and it's not taking place in 3 days. So, yeah, if you study history very much, and I'm actually a trained and experienced history educator, the things that he's trying to change started well over 100 years ago. You could go back to Teddy Roosevelt for some of this, and all these changes have been going on for quite a bit of time, 120, 125 years roughly. And Trump has said, okay, if you elect me, I'll come in and I'll change these things. And it's going to produce some short-term pain that could even be a little bit longer term. And the way that generations now have been thinking about things, he's trying to change that back. And you might agree or disagree, but that's what he's trying to do. And the market's unsettled by that. A lot of norms are being challenged right now with new ways of doing things. And of course, the pop news and the emotional side of it all, that's just all the craziness. There's a deeper level to all of this that is trying to be attempted. And there is a plan behind all of this. And in that process, though, interest rates are coming down um, because they're seen as a flight to safety, coming out of the stock market now into the bond market. And we'll get a bigger reading on inflation this week. We're going to get CPI and PPI coming out, and those are the big inflation reports. And as far as geopolitical things, yeah, it's all the stuff going on right now. And it's really rattling things. And the stock market doesn't like uncertainty because they're having a hard time figuring out, okay, what's this going to mean? How are these things going to change? We're used to doing things a certain way, and now we're having to shift and look at doing things a different way. And they don't like that. And when in doubt, sell. And that's what we're seeing right now. Okay, so some comments. We're below the 200-day moving average now with the S&P. That had been a support level that held as of Friday. I went over it in the weekend videos. We were really watching that. Well, we opened below it and never came back up to it, at least for right now. So that's more negative in the long term. And President Trump, there was an interview over the weekend that he did, and he said in that interview that the U.S. economy is going through a period of transition. Okay. And he declined to answer directly if the U.S. will experience a recession. There have been, of course, there's always the economists that just go with whatever's happening. We're having a bad day, cut rates, cut rates. We're having a good day, they just go with the flow. There's a few economists out there that I tend to listen to, um, and they're probability of a recession is still quite low, but they are raising those probabilities. Another economist that I listened to, even before the election, was saying if Trump is elected, we will probably go into a recession given the things that he wants to do. And we're watching the charts. We'll just see how things play out. So far, the employment area has been holding up quite well. If that starts to really fall apart, then yeah, it's going to look like we're going into a recession there. But over the weekend, when I did the videos, the charts that we look at actually show it declining with inflation. Now, the idea that we might go into a recession, that's starting to increase. But this inflationary topic that we've been really focused on, that seems to be lessening. And I have a few charts to show you there, and we'll go through that. And the mega caps are getting hit. Now, when we're really going up and the market's positive, these are the stocks that everybody wants to own because they outperform the market. Unfortunately, when we're under pressure and we're going down, they outperform to the downside. They go down faster. And there is this shift that's going on from growth to value, and that's where the market is becoming more defensive. And we're still at some long-term levels though. But if we break below that, then yeah, things are probably going to shift a lot more in a defensive way. We're still really high with the VIX. We're at 27.86. Fear is really increasing there. And we have a really long list now with our short-term oscillator or short-term indicators. Many of them are oscillators showing that we're down extreme right now. Now, because we've dropped below the 200-day moving average, maybe this is going to last a little bit. But when we usually get this long of a reading, that can often mean that we're seeing some kind of a bottom. We don't know that yet. We can just look at the evidence and say, okay, these are some of the reasons why the market might bounce from here. And looking at the other evidence, these are some reasons why the market is quite negative right now. That's my approach. I don't forecast. We just look at the evidence and then say, okay, here are the possible scenarios. Let's go with those. But the VIX is going back up really quickly right now. And because stocks are going down, that's why the VIX is high. It's extreme. And even in the short term, we're getting above 40 now with the short term trend. And the rate of change going back 5 and 10 periods, that's also extreme negative. And the Stochc RSI, Williams percent R, CCI 14, 20, and stochastics. These are usually on our list. The other things on the list don't usually show up all that often. The standard deviation, we're down in the -3 channel. The slope oscillator, we're getting very extreme there. That's our short-term momentum oscillator. We're still far away, and now even farther away from the 20-period moving average and the short-term RSI based on 9 periods. That is extreme negative there. We're starting to see more of an increase in the intermediate term. The rate of change going back 50 periods, even the vortex, and I'll show you that. It's not that we're getting extreme as far as selling, it's that we're getting extreme as far as buying. We're getting extreme negative there. And this should be 50, the boom 50. We're far away from the 50-period moving average. The TTM squeeze has been on here for a few days, as has the Sean trend meter. We still have this non-confirmed Hindenburg Omen. If we get another spike, then it will be confirmed. And no change to the scenario yet. We're just letting the market play all this out because Chairperson Powell came out last Friday and said, I'm kind of pleased with productivity, and I don't think we're going to be doing anything with interest rates very soon. So that scenario has not changed. But the dollar for the first time in a while was actually up during the cash session, and interest rates were down as this flight to quality is happening. We're at 4.21% with the 10-year yield, where after Friday we were at 4.32%. Sentiment is negative. We're just keep going down, 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 but we've camped down under 25 now for a while. And as I pointed out over the weekend too, that usually in a more positive environment, we start seeing a pullback. Sentiment comes down to 25 or thereabouts, and then we just V bounce out of that. Well, that's not happening. We've been camped down in this extreme negative area for quite some time, and we're coming in at 15, where after Friday we were at 20. And we're back to being inverted with the 10 to the 3 month yield curve. And everything I talked about here, I'll show you charts. We are negative with our trend. We're above the moving average. We're above 20. The red line's on top. And the bias is negative with the massive down day on a relative basis. And momentum is also negative. We didn't have any economic reports to go through, so there's no charts there. You might want to pause and look at this. Now, this is if you're a longer term investor. Missing the best 10 days of the year can crush returns. Okay. It depends on how you work the numbers here. So you might just pause this and look at it and see if you agree with it. Valuations. We are coming down, but we're still expensive. And I go over that in the weekly video when I do the intermarket analysis update each week. But with the NASDAQ 100, we are coming down. We're still above 20. We use that 10, 15, 20 scale. We're at 26 according to this chart. Again, here, we're at 23 with the Russell. But when I show it over the weekend, we're at 15. So we're the S&P, that's about where we've been coming in. Now, this chart was before a Monday session, so it's likely these numbers have come down a bit. The equal weight is more fairly priced. And then the mid caps, this is about what we've been seeing lately. So depending on how you figure this out, and then I don't know how you figure this one out. I'm actually kind of proud that I don't know. It's the probability of a U.S. recession as implied by the markets on March 4th, the day the tariffs in Canada, Mexico, and China became effective. So somebody has some kind of algorithm that they use to say, okay, what's predicting that we're going to go into a recession? And some of these areas are pretty high, some of them are a little bit lower. Okay, then consolidated equity. We're actually dropping below zero now. As we've been going down, folks are taking money at least out of this type of positioning. And then the concentration of the S&P 500 market cap and earnings in the 10 big companies, it's coming down a little bit, but you still have the 10 biggest companies accounting for 36% of the market cap and 26% of the earnings. And then Europe is really doing pretty solid these days, but a lot of that could be their defense stocks. And this is what we're starting to see in the US. We're seeing going from growth into more defensive areas. Now we could stop this at any given time and start to go back into growth, but this is a trend that we've been seeing over the last few weeks where we're going from growth to value. Well, they've already been going to growth to value in Europe, and we're actually seeing better returns when you compare European returns to US returns. And this is like, okay, tell me something we don't know. At the beginning of 2025, we have everybody comes out with their projections. And yeah, since we've been going down, we're below that right now. Gee, you think? Okay, and then European stocks are outperforming the US this quarter. That's really, and I went over that over the weekend, that Europe has been holding up better, at least recently. Now, they didn't have a good day on Monday, and this could switch back at any time, but this is what's been happening up to this point. I didn't spend any time on Twitter or X there, at least looking for charts here. I figured we had enough to go through with what I show, but we gapped lower at S1, worked our way down to S2, broke below that. This is right around some long-term support that I'll show you here in a moment. And then we bounced up a little bit to close slightly below S2. And we're down a little bit in the overnight session, but we were just negative. We were drifting lower, and then when the pre-market session opened, that's when things started to get negative, and we just carried that through until we finally hit the bottom during the cash session. We're still negative here because the red line is above the blue line, even though both are going down. And we're seeing it's kind of leveling off here. But when you take a bigger picture look at this, when we look at growth of value, this is showing the rotation going out of growth into value, which is more defensive. End of day, my goodness, look at growth down 3.87%. Value got smacked too, but a mere 1.64%. And it was down much more with the mid caps and actually down less with the small caps. So looking at our end of day chart, we're still falling down here with the small cap growth to value ratio below the 200 period moving average. We're declining with the mid caps. We're also declining with even more velocity now with the S&P 500 growth to value ratio. We're falling down out of the rainbow. We were kind of hanging out near the end, the lower end of the rainbow. This is really showing some weakness right now. And we're coming down kind of fast here with discretionary to staples. Discretionary is coming down with this equal weight ETF. It's testing its 200-day moving average. But staples, this is defensive. Now we closed well off the highs here, but when you compare these two charts, we're still going down and dropping below the 200-day moving average with discretionary to staples when we look at the ratio. And we're falling a little bit further below the 200-day moving average with large cap growth. And this is the intermediate term chart where we are negative. The ADX is going up. We're above the moving average. We're above 20. The red line is back to going up. I was trying to point out over the weekend that we were seeing some kind of working down of the selling here. Well, and that could still be happening, but we did go back up in Monday's session. Now, this is where we could be getting a little extreme in the short term. The ADX is actually going above 40. Now, we could go up higher than that. You can see here that this really went up big time, but that was in a positive way. But we'll just watch this. And we're considering this to be extreme negative right now in the short term. And we're well above average with volume here. And then once a week, we come out with the sentiment gauge, and we're pretty much neutral. Where if you look at the gauges we follow, we're way down over here on the left-hand side. We're quite negative there. We are keeping an eye on this. Not much of a change on Monday. This is the spread between risky, like junk bonds, and not risky bonds, like government bonds. This coming down is causing some concern. And that just means there's an increase in fear. So we're just keeping an eye on that. And I have it in the sentiment area because it's how people are feeling, at least in the bond market. We're really going up here with the Ulcer Index as fear is increasing. We're going up with, this is the VIX of the VIX, which is really increasing overall as the VIX itself is really going up. Pretty high level right now. And that produces negative annualized returns. We're up kind of extreme here with the VIX, meaning that the VIX is going up high on a momentum basis really quickly. And the momentum of the VIX continues to be up. And this fear gauge is up, as is the other fear gauge. Not a real surprise there. We actually ticked up a little bit here with the equity put call ratio, but our 5-day moving average is still going down. Our 10-day is just, it went up a little bit, but it's just kind of leveling off right now. Not getting a lot of insight from that. And then we look at the risk on to risk off ratio, really coming down 2.5% here. This is also showing the market is getting more defensive. We actually ticked down and came back into the range with volatility risk premium. On a down day like we saw, you would expect us to go up. It actually declined. Then, and I pointed this out over the weekend, and I have been now for a while. The advanced decline line is holding up fairly well, especially based on price. We're just chopping along, and this could be because we're going out of growth and into value. But then we see some weakness here. It could be coming more out of growth, like the big stocks, because they trade more and they have heavier volume. So we're seeing selling in that area. So that's why this is dropping. But longer term, we're still above both of these moving averages. And we're just hanging out right around the zero line with our advanced decliners over a 10-day period. And we even with the down day, now this could be some value stocks that are hitting new 52-week highs, but look at the big upsurge in new highs. Now we did see some new lows as well. We're still going down with the 5-day, and we're leveling out and trying to turn back up with the 10-day moving average. And we're just hanging out around the zero line with the advanced decline ratio. So internally, the S&P is holding up quite well. And we're still above the moving average with accumulation distribution. We're not negative until we actually drop below it. Again, it could be some shifting going on. The whole boom indicator is just going crazy right now, though. I would disregard that for right now. We're still negative with this smart money indicator. Even though it came up, we actually bounced up a little bit here with the histogram with the Chaikin money flow, but the red line is still going down. We're actually positive now with the Chaikin oscillator. We're above zero and going up. And the vortex, this is what I wanted to talk about. The red line's above the green line, but notice how the green line is coming down to this extreme negative reading. That could mean that selling is getting oversold at this point. So, but we're still negative when you look at all of this chart together. Now, I had pointed out over the weekend that this light blue line, which is the low set back a year ago, April of 2024, that we had held up above this blue line. Nah, we broke down below it this time. So that's making things more negative, that this support level had actually not held. Now we're coming back down to a pretty significant low. This was the low in October of 2023, and that we bounced up out of, and we've been in the bull market ever since. If we come down to that, that's going to be a pretty severe test. And now you look at the cumulative advanced decline line for the S&P based on price, just moseying along, chopping sideways, seeing a little bit of a decrease here when we look at volume. But then again, as I said, that's the bigger stocks being sold. And so that makes this go down, even though some of the smaller stocks, which are value stocks, are being bought. And we're actually seeing it pair up a little bit here. When we look at the S&P 500 with the NYSE advanced decline line, it had been underneath, and we're dropping below the 200-day moving average. Now, this moving average is of the NYSE advanced decline line, just showing a continuation of the weakness here. The NYSE cumulative advanced decline line really came down. We're dropping further below the 50-period moving average. We're also dropping down with this other NYSE advanced decline line and dropping down when we look at common stock based on price and volume, but not screaming, but it is declining. And we're still above the moving average here with the S&P 500. Now we're seeing more weakness here with the advanced decline line with the NYSE common stock, mid caps, and small caps, but this has been holding up fairly well for the S&P. And we're negative here, though. When we look at the 5-day moving average of the highs and lows across the broad market, we're continuing to decline below zero. And we're below 50 and declining, but chopping around here. There's some mulling, churning going on here within the S&P 500. So we're not seeing this really shoot to the downside, given the downward move that we saw with the index. But these are the stocks inside of the S&P above their 20-period moving averages. And we're negative here with those stocks above their 50-period moving average, but not really screaming down. We're seeing a little bit more weakness with the 100-period moving average study, and now we've dropped below 50 again with those stocks above their 200-period moving averages. And we're below the 200-period moving average here. Haven't seen red now for quite some time. We are 2% below the 200-day moving average. And this is that same basic thing, but we're dropping below 50 here with those stocks above their 200-day moving average. And short term, yeah, just not looking really good right now. We're below the 200-day moving average, awful lot of red coming down, and we're seeing a real pickup in volume here. But not much of a change with the 20, 50, and 200 period moving averages, still just kind of drifting lower overall. But when we measure the distance away from the 20 period moving average, we're getting really far away. And also we're getting far away from the 50. We're also starting to cross below zero because we're dropping below the 200-day moving average. And we're extreme negative here with the Stochk RSI, Williams percent R, CCI 14, and 20. These are usually on our list if we're moving with any kind of conviction, either up or down. Also, we're extreme with the short-term stochastic, intermediate, short-term stochastic, and the long short-term stochastic. hitting the Keltner band here, down here with the force index. That's extreme negative. The seeing a further deterioration and a not friendly bar pattern here with lower highs and lower lows. But the short-term trend is negative, and we're below the 20 period simple and exponential moving averages. Looking pretty scary right now. Now, the rate of change going back 5 periods, we could be getting extreme. Now, this happened on the end of the world day last August, and we were able to bounce up out of that. Now, we need more confirmation, and this could still go lower than where it's at right now, but this might give some hope to the market. And then when we look at the 10-day rate of change, this also was the end of the world day, and we had a real extreme negative, and we were able to bounce up out of that. Now, are we seeing a convergence of things? Just keep that in the back of your mind as you see some of the additional charts here that I'm going to be going through that were extreme in the 5-day and 10-day rate of change. Okay. And we're extreme here with the standard deviations chart. We're in the -3 channel. Now, we're negative with the balance of power, below zero and declining. That's negative. We're negative with the go, no go, with lots of purple bars there. We're hitting and dropping down with the lowest low value. This is all negative stuff. This is what I wanted to point out. Now, from the high that we set back in February until in the intraday low that we set on Monday, we're down 9.46%. Okay. If you go back to last August, the end of the world day, when we set the all-time high in July, then we had the end of the world time, we fell 9.72%. We're what, a third of a percent away from that right now. And then the smart money said, okay, enough. We're going to come in and start buying. And they came in and started really pushing things up. We're getting really close to that point, and we might even be at that point already. Now, things are different in July. We have a new administration. We're doing these tariffs. There's been inflation concerns. Interest rates have changed. I mean, it's not an apples to apples comparison, but this is what we're going to be watching for. We came down. We finally hit a point where the smart money said, okay, we're going to come in and drive this market back up. Is that going to happen now? Now, if we lose this, if we keep going and we fall under 10%, that's correction territory. And that means, yeah, things are turning quite a bit more negative. So that this is one of these kind of long-term support areas that we want to keep an eye on. Now, we're still negative and extreme negative with the TTM squeeze. There's a longer term chart to show you. And when we get down to the low reading where we see it right now, a lot of times we saw a bounce up out of this. And then the rate of change going back 50 periods. Again, this goes back here. If you go back to October 2022, okay, we saw much lower readings. But when we drop below the green line here, this was when we hit October 2023, which ended up being a fairly significant, that's considered a pretty big low. This was the big low, October 2022. Then we came up, fell back. And then October 2023, then we really came up out of that. Are we going to see that this time? We don't know at this point. If we lose this and this continues to show deterioration, yeah, then what we saw before is not necessarily going to happen this time. All right, standard deviation, we're still moving down pretty fast right now. This measures speed, not direction. Going down with the ease of movement, that's clearly negative. The McClellan oscillator, yeah, it's negative because it's below zero, but it's holding up. It's not screaming to the downside right now. And that could be some of the rotation going on inside of the S&P. But we are declining with the summation index based on price, and we're falling further below the midpoint here based on volume. So we're negative this way. And we are seeing a little bit more weakness here with the NYSE McClellan oscillator. It's coming down here below zero. So we're declining with the summation index based on price and volume. The Arun is negative, and it measures buyers, which are green, sellers, which is red, and then creates that oscillator from that. And we're negative there. Going down with the Swanland trading oscillator, based on price and volume, both are below zero. That's negative. Momentum is clearly negative with the PMO going down. We're going down based on price and volume, but we're not seeing a huge deterioration here. Remember, this study takes all of the PMOs, the price momentum oscillators, inside of the S&P 500 and then says, okay, what are the percent of those that are going up? Now it's declining, but it's not screaming down right now. There's some positive things going on inside of the S&P. It looks like it's a shift from growth to value. But if we bounce up out of some of these support levels, it could quickly go back from value to growth. That's the scenario that I'm watching to see play out right now. And we're going down here with the buy signals, but not with any real velocity. We are declining here with the PMOs that are above zero. So there's some weakness. You can't discount that. And we're negative here with the Elder's Impulse system for the S&P with a red bar. We're clearly negative with the parabolic SAR. I don't have the chart here, but over the weekend, I showed the weekly chart of the parabolic SAR, and we had a dot on the top after last week. So longer term, that's turning negative. And slope really getting extreme down here, negative. And we're really possibly getting really extreme negative with the MACD. So we're going down with the short, intermediate, and long term. I mean, it's not hard to figure out. When you see a chart with declines like this, yeah, the momentum's going to be negative. What we're trying to figure out is, okay, when have we hit what potentially could be a bottom here? And the Copic curve also getting extreme, but is negative. And we're extreme negative with the Sean trend meter. We're down in this pink area. And then this is interesting. I've never seen this make a mistake like this before. This is the Bollinger Bands on top, and the percent B measures if we close above or below the upper or lower band. We clearly close below the lower band here, but it's not giving us an extreme rating right now. So something's a little off here. But we are considered extreme negative with this chart. The money flows below 50 and declining. We're below 50 with the ultimate oscillator, so that's negative as well. We're below the moving average with on-balance volume. That's negative. We're getting extreme negative with the short-term RSI. We're really close to being extreme with the intermediate term RSI based on 14 periods. And yeah, the intermediate term trend not looking very pretty right now. And we're below the simple and exponential moving averages based on 50 periods. We're below the simple and exponential moving averages based on 100 periods. And we're below the 200-day moving averages now. So yeah. All right, but now this could be positive. The mass index, it hasn't generated all three criteria yet. Criteria one was when it went above the dash line. Two is above the blue line. Three will be when we cross back down below the red dash line. And since we're going down, the mass index tries to predict a reversal. Hasn't quite triggered yet. Same thing here with the Pring bottom fisher. Still hasn't crossed above the red line. So it hasn't given us a signal yet. Now, this is interesting. The bullish percent index is actually back to positive. We went up and we're above the moving average right now. There's buying going on in the S&P. Is it value? It looks to be the conclusion to this point. Or what we're going to see is if we get a bounce up out of this, is it going to quickly switch back to growth? But we're still declining here with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. Now, because the NASDAQ 100 is growth and we're seeing it going up in the S&P, the logical conclusion right now would be, yeah, it's going up because there's value that's being bought, which is meaning the market's rotating over to become more defensive. All right, now we're below this Ichimoku cloud. It's like in the rear view mirror right now with the green line below the red line, excuse me, the blue line above the blue line below the red line and the green line going down. This is kind of a big deal here. Fib retracements. We sliced through the 61.8% retracement level where we closed just a little bit above that on Friday. We're dealing with the 50% retracement. And this measures from last spring's low up until the high that was set in February. And we're testing. This could be longer term support. Now we didn't quite come down to this and we're still above it. If we break below that, it's going to be much more negative. If we can bounce up and get back above the 61.8% retracement level, that's going to help things at least bounce a little bit. Now, this is the big one. And for, my gosh, what was it, a year ago? I was using this chart every single day. I haven't used it for a long time now. There hasn't been a need. This is a weekly chart of the S&P with pivot points, and these pivot points last for the whole quarter. And we've come down right to this pivot point, and we're a little bit above it right now. That's the line in the sand between long-term positive and negative. Now, we did drop down a little bit below it here. Now, if we fall below this, that's going to turn things more negative. Now, are these pivot points important? Okay, what I go back and I show when we were coming up in 2021, we hit this pivot point and that was the high, and we didn't get back there for quite a while. Then we went into 2022. We started to bounce back up. We hit another one of these pivot points and then fell back. Then we finally broke through that, and then we've hit some other pivot points, danced around here. The market knows these things, and the big algorithms, the computers that trade, they're programmed with this stuff in them. And so they're told if we get near here, buy. If we get near here, sell. And then we broke above this, and then when we fell back, this was the end of the world day. We came right down to this pivot point and then bounced up out of that. So yeah, these are really important levels, but they're longer term because this is based on a weekly chart and these last for an entire quarter. We're right at that point right now. And this is going to tell us something. If we bounce up out of that, things could get better. If we fall down below this, things could get worse. All right. And then this is longer term, going back to 2009. We hit this upper end of the trend channel, and that's when we started having the problems. All right, we are negative when you look at trend, all the different ways to look at it here. Heiken Ashi is negative. Kegi red pointing down, that's negative. The Renko chart is negative. The three-line break is negative. And we've had some new O's drawn in here after our double bottom breakdown that was triggered on February 27th. Long term, seeing weakness here, falling further below the midpoint or the 250 range here with the 150 period moving average study. And now we're dropping below the midpoint with the 200 period moving average study. And we're still just plain all negative in the short and intermediate term with all the stocks, still positive in the long term. And bonds are still holding up fairly well in the short and intermediate term. Commodities are still negative in the short term. And the dollar bounced up, but we're still in a downtrend in the short and intermediate term here. Only two sectors were up, and they are defensive: utilities and energy. Lots of red. Well, we did see a BPI or crossover. This is when the 50 period moves above the 200 for energy defensive. Then we just see it's like a countdown to a blast off here. NASDAQ 18-1, 18, 17-9, 8, 7, 6, 5, 4, 3. All right. And then we had the S&P crossing below 5,700. We had a BPI cross below 20. Now that's extreme negative with the tech sector. Are we going to get some kind of a bounce out of that? And if we do start to get a bounce, what's the bounce going to look like? Are the growth to value ratios going to improve? Or are we still going to see value holding up? That could just be a counter trend bounce before we get set to go even lower. See, those are the things that we're going to be watching here. And then gold's even getting hammered these days, and Bitcoin is down into the 80,000 range or so. All right, now I haven't shown this in a while in this video here. We're seeing more of a matchup between the weighted and equal weighted version of the S&P, even though they're on different scales. When they're in lockstep with each other, that means they're both performing about the same. When the bar chart is above the red line, that means the S&P weighted version is outperforming the equal weighted version. And we're seeing that here. This is coming down where the weighted version is now underperforming the equal weighted version. It's kind of catching up. And another ratio here, the equal weight is outperforming the S&P, but we haven't seen an awful lot of conviction in here lately. We're dealing with the 200-day moving average with the Dow. Now, if you watch the deep dive video over the weekend, the Dow's the best index right now, and it was coming in the 50s. All right, so it's not anything great, but it's the best of all the other indexes currently. It's dealing with its 200-day moving average. Is that going to be a big deal? Now, I tend to discount the Dow because it's only 30 stocks, and the S&P has 503 stocks, and there's much better indexes in my opinion. But there are millions of people out there that do focus on the Dow. If you turn on financial media, oh, the Dow, the market's up 1,000 points, down 1,000 points. They're talking about the Dow, even though, in my opinion, that doesn't really tell you anything. First of all, point values don't tell anything. You need to know percentage. And that's why I focus more on that. All right, so we are negative with the diamonds, which is the ETF for the Dow. We're dropping further below the 200-day moving average and actually testing this S2 support level with the NASDAQ and testing this, but we still closed up off of it with the NASDAQ 100. We're negative with the Elder's Impulse system for the Qs. Momentum is negative for the NASDAQ 100. We were right at the 200-day moving average on Friday with the Qs. Not any longer. We're below it now. 3.88% below the 200-day moving average. Small caps, which were doing bad, are doing even worse. But notice how they came down to this S2 level and found some support. Are we going to get some kind of a bounce out of that? And we're getting really close to a death cross here. The blue line's coming down to the red line. If they cross, that would be a death cross. That means the trend is now negative. And we look at the Russell 2000 small caps, pegged at extreme negative with the RSI, well below the 200-day moving average, and momentum is clearly negative and possibly even extreme negative. And here we're negative with the Elder's Impulse system for the small caps, coming down closed right on this pivot point for the mid caps. You think these pivot points are important? That's why I update them every day on the YouTube community tab. You can go look at them. You can download them yourself and just watch these different things. Yeah, they are very important. And we're negative though with the Elder's Impulse system for the mid caps. And this has been a concern too. We're seeing more weakness in the financial sector as it's dropping further below its 50-day moving average, even though it's still in a longer term uptrend. Because the banks, which are holding out at their 200-day moving average, have now fallen below that. And here's a ratio. This is a concern. The regional banks, the financial sector. This big dump that we saw here, that was when Silicon Valley Bank went under. And then we started to get a little better, and then Republic Bank, and then we dumped down again when New York Community Bank. Are we going to start getting some bad banking news with rising interest rates and all the cuts and everything going on? Because the ratio down here, the financial sector's been under pressure, but it's still positive. But the regional banks, the smaller banks, they are clearly underperforming enough to give us a downtrend right now. All right, the Wilshire was hanging out above its 200-day moving average, not any longer for the time being. We're also below the 200-day moving average with the total US stock ETF. We fell below the 200-day moving average with the FANG index, where that had been holding up. The robotics and AI ETF, because that's the rage right now, we're falling further below the rainbow. This is a new ETF that I've been showing in the videos, falling below the 200-day moving average here. But notice how we fell under it in the end of the world day, and then we were able to bounce from that. We're It's like the market needs some more climactic, just panic, just sell, sell, sell. The market's never going to go up ever again. The perma bears are dancing in the streets, thinking that we're finally right, our slight percentage of the time. But this is kind of how it was last summer. Everything was going crazy. Have we already reached that climactic point? Or is it still needed to happen? Now, if we keep breaking the support that we're breaking now, then yeah, things are not looking all that good. All right, Amazon down 2.36% below its 200-day moving average. Apple down 4.85%, right at its 200-day moving average. Microsoft already in a downtrend, down 3.33%. Google down 4.5% below its 200-day moving average. Meta, which just came off of setting an all-time high here, down 4.42% underneath its 50-day moving average. Nvidia down over 5% below its 50-day moving average, in danger of seeing a death cross. Tesla, now of course, it's become cool now, depending on where you stand, but it's become cool now to hate Elon Musk. So people are out, drawing, swastikas on Tesla trucks, and it's crazy. It's pop mob mentality. Um, but a year ago, global warming, we've got to have electric vehicles. Well, now that Elon Musk supports Trump, well, let's destroy electric vehicle. It's so crazy. But this has been under a lot of pressure, and it's down another 15.5% in Monday's session. All right, Netflix down 2.76%. This is one of the better looking charts, but it's getting sucked down with everything else. Now we're seeing a real spike up here. This is growth to value. Staples going up compared to tech. And we're seeing more of a weakening here in the short term when we compare US to world stocks. And the red line, that's the S&P. The bar chart here, that's the world index when you take out US stocks. World stocks are actually holding up better right now. We're even deteriorating more with the long-term correlation. And oil continues to drop, which is happy, but it comes down. Is anybody going to even want oil? Well, we better freak out about the economy. Now, here are some ratios that I usually just go over in the weekend, but we're seeing quite a hit here to some of these. This is, are we going to go into a recession or not, based on what the market is thinking? That's being thrown into doubt here. So we're seeing this ratio really coming down. Now, this is an inverse of that same chart, showing how bonds are really coming up compared to stocks. Now, we look at Qs to bonds falling further below the rainbow, tech to bonds further below the rainbow, broad market to short-term bonds further below the rainbow, broad market to further out bonds further below the rainbow. The dollar, actually, it shows it down here because it trades 24.6, but here we were actually up a little bit. All right, then we went back down here with the 10-year yield. We're going back up a little bit here with the 10-year based on price. Keeping an eye on the Japanese 10-year yield. Doesn't seem to matter. We're going down anyway. So this is what caused all the freak out last summer, but I haven't even heard anything about it as it's applying to things that are happening right now. All right, and we're back to being inverted with the 10 to the 3-month yield curve. The 10 to the 2 is still regular. It's coming down, but it hasn't gone inverted yet. And this is meaning that the market is perceiving a problem with the economy. All right, and we're going down with our growth to value ratios. Q's to S&P, discretionary to S&P, large cap growth underperforming large cap value, going down with the large caps, mid caps, and small caps. Going up with staples. That's defensive. We're really going up here, and that's more negative. All right, what's the outlook for Tuesday? We're negative in the short and intermediate term. We're below now the 200-day simple moving average, and we're testing that long-term support. That's the weekly chart of the S&P with the pivot point. All right, we're going to get NFIB small business optimism and JOLTS job openings. Not major, but still things we need to pay attention to. Anything geopolitical and political and Doge, executive orders, all that stuff. That's really messing with the markets right now. And then Wednesday, we're going to get CPI. Thursday, we'll get PPI. Friday, we'll get consumer sentiment. Here's a look at the calendar for the economic reports. Seasonality is kind of positive, though, for March 11th. Positive for the Dow and S&P, neutral to positive with the NASDAQ. And then looking here, depends on how you measure it, but even whether it's a post-election year, which are the dashed lines, or the solid lines, which is like all the years together, we do see a bit of a bounce around about now, but then we see some weakness after that. It's really gets a little choppy, but we kind of tend to work our way up here on a seasonal basis. All right, and then the first half of March is supposed to be the second best performing time of the year. Tell that to the first half of March so far. And this tends to bode well, but not lately. And this is more choppiness before things hopefully will clear up and get a little bit better. All right, so now we're still seeing a mixed signal, believe it or not, with our smart money indicators. We're above the moving average with accumulation distribution. We're Chaikin money flows going down, even though the histogram came up, where the Chaikin oscillator is actually positive. And the S&P and NYSE McClellan oscillators and summation indexes, they're negative, but not falling off a cliff. And the parabolic SAR is negative, and we're negative with the NASDAQ 100 and NYSE bullish percent index. We've gone over to positive with the S&P bullish percent index. And we're negative on a momentum basis. And the swing trading oscillators negative. The moving average steady showing weakness, but not falling off a cliff. The ease of movement, the money flow, and the ultimate oscillator. Those are all negative. And the vortex is negative, but maybe a little too negative as far as a lack of buying. And the momentum for the NASDAQ 100 is negative. Positive side, the long-term trend for growth to value is still positive, but it's really getting hit. It's been weakening, and in the short term, it's actually negative. And we're still going down with the 5 and 10-day equity put call ratio charts. And let's see, we're above the moving average with the S&P on the advanced decline line. And the bullish percent index, as I said, for the S&P has now gone positive. The financial sector is positive, but getting hit now. The bank is under its 200 bank ETF is under its 200-day simple moving average. And as I showed you, the regional banks are really underperforming the financial sector, and the financial sector has been under weakness. Okay, so our conclusion, we're negative in the short and intermediate term. We're still positive in the long term, even though we're still below or we are below the 200-day simple moving average. We're negative and oversold in the intermediate and short term here, and we're below the 200 period moving average in the long term. Now, that's one of the criteria for it being negative. I'm still keeping it positive because of the moving average crossover still being positive. Thank you. I hope you found this helpful. Have a wonderful day on Tuesday, and I will talk to you in the next video.